The economy grew last year. GDP was up, corporate profits hit record highs, the stock market had a banner year. Unemployment was historically low. Every official metric said things were good, great even. And yet, you looked at your paycheck and something felt off. Maybe you got a 3% raise, maybe 4%. Your manager called it strong performance. HR said it was above average. And still, somehow, at the end of the month, you have less room than you did 2 years ago. Groceries cost more, rent went up. The vacation you used to take without thinking twice now requires a spreadsheet. You're not imagining it. You're not bad at managing money, and you're not alone. There is a gap, a real, structural, measurable gap between how the economy grows and where that growth actually goes. And the way the system is designed, that gap is not a bug. It's closer to a feature.
Here's the thing about GDP, gross domestic product, the number everyone uses to measure economic health. GDP goes up when money changes hands. That's essentially it. When corporations earn more, GDP goes up. When asset prices rise, GDP goes up. When the government spends more, GDP goes up. What GDP does not measure is how that growth is distributed.
A country where 10 people each earn $100 and a country where one person earns $901 and 9 people earn $11, both can have the same GDP. The number doesn't care. The headline doesn't distinguish. So when you hear the economy grew 2.8% last year, the honest follow-up question is, grew for whom? Because for the last 4 decades in America, the answer to that question has been remarkably consistent and remarkably convenient for some people. Let's talk about one of the most important economic statistics almost nobody discusses outside of academic papers. Since 1979, American worker productivity has increased by roughly 65%, meaning the average American worker today produces significantly more value per hour than they did 40 years ago. Wages over that same period, adjusted for inflation, have grown by about 18%. Read that again. Productivity up 65%. Real wages up 18%. That gap is not a rounding error. That's not measurement noise. That is 40+ years of workers creating more value and receiving a shrinking share of it. Where did the other 47 percentage points go? Corporate profits, shareholder returns, executive compensation, capital gains. The people who own the machinery of production captured the productivity gains. The people running the machinery, that's most of us, got a fraction. In the 1950s and 1960s, productivity and wages moved almost in lockstep. A rising tide really did lift most boats. Then, somewhere around the late 1970s and early 1980s, the lines diverged, and they never came back together. That divergence is the story of the American middle class. It's the story of why a single income used to support a family, and now 2 incomes barely do.
How the labor market actually works. Now, here's where it gets structural. Most people believe wages are set by supply and demand. If workers are scarce, wages go up. If workers are plentiful, wages go down. That's the textbook version. And like most textbook versions, it's incomplete. Wages are set by negotiating power, and negotiation power is not evenly distributed. When you negotiate your salary, you're typically one person across a table from a company that has an HR department, salary benchmarking data, a legal team, and the ability to simply wait for the next candidate. The information asymmetry alone is significant. They know what everyone in your role makes. You're guessing. Now, layer on a few decades of structural changes that have systematically shifted that power further away from workers. Union membership in the U.S. peaked around 35% in the mid-1950s. Today, it's around 10%. Unions, whatever your political view of them, functioned as a countervailing force, workers negotiating collectively instead of individually. When that force weakened, so did workers' leverage.
Then add the threat of automation and offshoring, real or implied. It doesn't matter if your specific job can actually be moved overseas. The perception that it could moderates how aggressively workers' demand raises. The threat is the policy.
Then add the gig economy, the rise of contract work, the reclassification of employees as independent contractors. All of these shift risk from the corporation to the individual, and in doing so, weaken the floor under wages. None of this is accidental. Each of these shifts had advocates, lobbyists, and beneficiaries. The outcome, a more flexible labor market, is more flexible in one.
Now put inflation back on top of all of this. Because here's the thing about that 3% raise your manager was proud of giving you. If inflation that year was 4%, your real wage just went down. You got a nominal increase and a real decrease simultaneously. And unless you're doing the math yourself, the nominal number is what you see. The real number is what you feel. This is not unusual. For most of the period between 2021 and 2023, wage growth in the U.S.
The economy was growing, corporate profits were strong, and real wages for median workers were declining. The press covered the wage growth. The real wage decline was a footnote. And this is the part of the story most people carry around without having language for it. They feel poorer. Their colleagues reassure them the economy is doing well. They wonder if they're doing something wrong. They're not doing something wrong. They're just not the variable the system is optimizing for.
Hype versus reality. The metrics that flatter the wrong people. There's something worth understanding about how economic data gets presented. When the government reports average wages, they typically report the mean, the arithmetic average across all workers. The problem with the mean is that it gets pulled sharply upward by extreme values at the top. If a CEO gets a $50 million compensation package, that drags up the average wage for millions of workers who saw nothing. Median wage, the wage of the worker exactly in the middle, tells a different story. It's less flattering. It gets less. Median wage, the wage of the worker exactly in the middle, tells a different story. It's less flattering. It gets less airtime. Similarly, the headline unemployment number, the U3 rate, doesn't count people who've stopped looking for work, people in part-time jobs who want full-time work, or people in precarious gig arrangements who are technically employed. The broader measure, U6, is consistently higher. It consistently gets less coverage. The metrics we use to describe the economy were designed in a specific era, for specific purposes. They are not neutral. The choice of which number to headline is itself a choice, and that choice tends to produce headlines that make the economy look healthier than most people's lived experience suggests. That gap between the official narrative and the kitchen table reality is not accidental. An economy that looks good on paper is politically convenient. An economy that feels bad to working people is a problem that requires explanation. Better to keep the metrics vague.
Zoom out, the bigger architecture. Step back and look at the full picture. You have a productivity pay gap that's been widening for 40 years. You have inflation that quietly erodes nominal gains. You have metrics that are designed to tell the most optimistic version of the story. And you have a tax and policy structure that, since the 1980s, has consistently favored returns on capital over returns on labor.
Capital gains, profits from owning assets, are taxed at a lower rate than ordinary income in the United States, meaning a hedge fund manager who makes money by holding stocks pays a lower tax rate than the nurse or the teacher or the software engineer who makes money by working. This is not a glitch. It was a deliberate policy choice made over decades by people who benefited from it. The result is a system where the most reliable way to build wealth is to already have wealth, where income from labor, the thing most people have to sell, is taxed more heavily than income from ownership, where every structural incentive points in the same direction, up, for the people already at the top.
Closing, the question that lingers. None of what I've described is hidden exactly. The data is public. The research is published. The policy history is documented. What's hidden is the synthesis, the connecting of dots that makes the full picture visible. Because individually, each of these things sounds like a policy debate. Together, they describe a system. And here's what I want to leave you with. When someone tells you the economy is doing well, ask them to be specific. Doing well by which measure? For which quartile? Compared to what baseline? The answer to those questions will tell you more than the headline ever will. And the deeper question, the one worth sitting with, we have more data, more economists, more financial modeling than at any point in human history. We can track productivity to the decimal point. We can measure corporate profit margins in real time. We know exactly where the money goes. Which means the wage stagnation of the last 40 years was not a mystery. It was not an accident. It was not a side effect nobody anticipated. It was a choice, made by people with the power to make it. The question is whether the people without that power ever decide they've had enough of the explanation.